Welcome to the deep dive, where we take your sources, your research, all your notes, and really try to turn them into actionable insights. Today, we're embarking on what feels like a really significant deep dive. It's one that I think resonates deeply with, the spirit of community, family, and the future. We're going to explore the vibrant journey of the Ethiopian diaspora here in the US. It's a story that, well, it fundamentally embodies resilience, collective strength, and this incredible drive to build a better life for loved ones. And central to this, as you've really highlighted in the materials you shared, is this beautiful, deeply ingrained tradition of mutual support. You see it exemplified in institutions like the EDIR. Okay, let's unpack this. We're going to dive into how a foundational American financial tool, life insurance, can not only complement these cherished cultural values, but maybe even amplify them, providing a robust layer of modern financial security for generations.
That's absolutely right. And our goal today, it isn't to suggest that life insurance somehow replaces the invaluable role of traditions like the EDIR. Not at all. Instead, we want to show you how life insurance can act as this modern, legally enforceable mechanism that really extends and fortifies the spirit of the EDIR, adapting it maybe to the unique financial landscape here in the United States. So this deep dive is all about helping you fully understand life insurance as really a cornerstone of financial stability, specifically tailored for the Ethiopian American community. We'll get into the different types, highlight its benefits, some might even surprise you, and crucially explain why starting early is just so key to building that strong, multi-generational financial foundation.
And that really is the core message, isn't it? The thing we want you to walk away with. It's not about choosing one over the other. It's about empowering your families with additional powerful tools for long-term security and, frankly, profound peace of mind. Think of this maybe as your shortcut. A way to get incredibly well informed on a topic that truly matters for your family's future. It's a topic that can elegantly bridge those traditional values with modern financial strategies, making sure the legacy you're building here is secure, come what may.
Okay, let's begin by laying that groundwork then. Bridging tradition with these modern tools. The EDIR, as you mentioned in your sources, it's such a fundamental pillar within the Ethiopian community, right? Both back home and here. Can you maybe elaborate a bit more on what it actually entails? Really bring its essence to life for us.
Absolutely. The EDIR is, well, it's a remarkable community-based organization, deeply ingrained in Ethiopian culture and really a testament to the power of collective responsibility. Imagine a group of community members, often neighbors, friends, maybe even colleagues. They come together and agree to contribute a small fixed amount of money monthly into a shared fund. And this isn't just about the money. It's really about a social covenant, a promise. Its primary function, and it's really heartwarming, is to provide immediate financial and maybe even more importantly, emotional and practical help to a family during a time of immense grief, specifically when a death occurs.
So it really is about more than just the money then. It sounds like a profound expression of that communal commitment, that spirit of collective responsibility when facing loss. I can almost picture it, the community rallying.
It truly is. It's a profound expression of, Ubuntu, I am because we are. It means helping cover the significant financial burden of funeral expenses, which, let's be honest, can easily run into thousands of dollars here in the U.S. But it's also about providing tangible care and support for the bereaved family. Things like cooking meals, helping with childcare, or, simply offering a comforting presence as they navigate their mourning. It's a holistic safety net built on trust and shared heritage.
That's genuinely powerful. And what's fascinating here is how life insurance, a central component of the American financial system, can be viewed not as a replacement for these cherished cultural values, but as a modern, legally enforceable tool that can complement and even extend them.
Precisely. That's the key distinction. While an EDIR primarily focuses on those immediate funeral costs and essential community support, life insurance offers a mechanism to provide a much larger, legally guaranteed financial safety net for long-term needs that extend far beyond just final expenses. You could think of the EDIR as maybe the vital immediate emergency response team. Life insurance, on the other hand, well, that's more like the comprehensive long-term reconstruction plan.
That's a really helpful distinction, the legally guaranteed and long-term aspects. Okay, so how would you formally define life insurance in this context? How does it really differ from an EDIR in structure?
Well, at its core, life insurance is a binding contract. It's between an individual and an insurance company. This contract guarantees the delivery of a specific sum of money. We call that the death benefit to designated beneficiaries, typically your loved ones. This happens upon the death of the insured individual. So it's a legally enforceable promise backed by the financial strength of the insurance company. That's different from the more informal, though equally vital, communal agreement of an EDIR. This legal enforceability, it provides a different layer of security and predictability. It ensures funds are paid out exactly as specified, even across generations.
Okay, so it's not just about covering immediate costs or funeral expenses, which the EDIR handles so well. It's about a much broader, legally structured financial strategy. So what's the comprehensive purpose, the real value of life insurance within a complete financial plan for a family?
Exactly. It really serves as a critical cornerstone for financial stability. It offers genuine peace of mind. How? By protecting against the potentially catastrophic financial fallout that can result from the premature death of a wage earner or, a primary caregiver. Think about a typical Ethiopian American family. Many are working incredibly hard, right? Sending remittances home, supporting extended family, and building a new life here simultaneously. If that primary earner suddenly passes away, the financial impact can be, well, devastating. And in a society where most families just don't have the personal financial means to self-insure against such a risk, life insurance provides an affordable way to manage this uncertainty through risk pooling. Many small contributions combine to cover large, unpredictable losses. It's a bit like an EDIR in principle, but on a different, broader scale and with that legal backing.
That makes so much sense. It allows ordinary families to get a level of financial protection that might otherwise be completely out of reach. What specifically can that death benefit cover then? Beyond just the funeral costs, what are the practical applications for a family here?
Oh, the death benefit from a life insurance policy can be incredibly versatile. It acts as this crucial bridge during a really difficult time. It lets individuals create a predictable financial cushion, and you can use it to cover all sorts of household debts, things like your mortgage, maybe car loans, any outstanding credit card balances, making sure your family isn't left struggling with those. Crucially, it can replace lost income, ensuring that your surviving family members can maintain their standard of living, that they don't face immediate financial hardship or have to sell cherished assets. And looking further ahead, it can fund future family goals like a child's education, maybe providing for college tuition, or even helping establish a new business, even if you're no longer there to contribute directly. It can also provide funds for things like long-term care for elders, which is a responsibility deeply valued in the community.
Wow. So by understanding and thoughtfully utilizing life insurance, you can really build upon your community's tradition of mutual support, creating a robust financial foundation that truly endures for generations. That's a really powerful takeaway.
If we connect this to the bigger picture, that's precisely the aim.
Yes.
It's about leveraging a modern, legally guaranteed financial instrument to, well, amplify the values you already hold dear, ensuring your family's security and prosperity for the long haul, both here in the U.S. and in terms of supporting family back home. It's truly a multi-generational promise.
Okay, that gives us a fantastic overview, a clear understanding of the why. Now, let's dive into navigating the landscape of life insurance itself. Here in the U.S., there are two main categories you'll encounter: term life and permanent life insurance. And understanding their fundamental differences in structure, cost, purpose, that's the first critical step to choosing wisely for your family. It's like knowing the difference between building a temporary shelter and a permanent home. Let's kick things off with term life insurance. You sometimes hear it called pure life insurance. What does that distinction mean exactly?
Right. It's called pure life insurance because its sole purpose really is to provide a death benefit. There's no additional savings or cash value component built in. It's straightforward protection. Just like, say, insuring your car for a specific period. This type of policy offers coverage for a specific, predetermined period or term. Typically, this ranges from 10 to 30 years. During that chosen term, you pay a fixed premium. If you pass away while the policy is active, your beneficiaries receive the death benefit. But if you live beyond the term, the coverage simply ends.
And I imagine its primary appeal is its affordability, making it accessible to more families, right?
Absolutely. Its affordability is a major draw. Premiums for term life are generally much lower than for permanent life insurance, especially for the same death benefit amount. This makes it a highly accessible option, even for individuals or families with more limited budgets. And this is a particularly important consideration for the Ethiopian American community, where, for instance, the median annual household income, as you pointed out in the sources, can be significantly lower than the overall U.S. median, maybe around $36,000 versus $50,000. This cost effectiveness lets you secure substantial coverage to meet those crucial, often temporary financial obligations like raising young children or paying off a mortgage without placing undue strain on your family's finances. It's about getting maximum protection for your dollar when you need it most.
That's a critical point, especially for families juggling multiple financial responsibilities. So, what are some common scenarios where term life insurance would be the ideal choice?
Well, it's ideal for anyone who needs coverage for a defined period of significant financial responsibility. For example, a young couple with dependent children might use term life to provide income replacement until their children become adults, financially independent. It's also excellent for covering a large debt, like a mortgage, while it's being paid down. This ensures your family isn't suddenly burdened with that huge debt if something happens to you. And another common use, ensuring that private student loans, especially those with a cosigner, wouldn't become a burden on a family member if the unexpected occurred. It just aligns coverage perfectly with specific, time-bound financial needs.
That makes a lot of sense, covering those specific time-limited responsibilities perfectly. Now, I've heard that some term policies can be converted. What's that about? And also, what happens if you just outlive the term?
Yeah, many term policies do offer that valuable flexibility. You can often convert them into a permanent life insurance policy later on, usually without needing another medical exam, though your premiums will likely increase. This can be a good option if your needs or financial situation changes down the road. However, this raises an important question. What happens if you outlive the original term? Well, the coverage simply ends. That's it. No death benefit is paid out because there's no cash value component to draw from. That's the trade-off for the lower cost and the focused protection. When insurance companies calculate these premiums, they use something called actuarial life tables. Basically, sophisticated statistical charts predicting life expectancies based on large populations, age, gender, health trends. They're predicting the likelihood of you needing the payout within that term.
Okay, so it's great for specific periods, but if you want lifelong coverage and something more, something that builds value,
Yep.
that's where permanent life insurance comes in. How would you define permanent life insurance and what's its really distinguishing feature?
Right. As the name suggests, permanent life insurance provides coverage for the entire lifetime of the insured person, as long as those premiums are paid. Its defining characteristic, and what really sets it apart from term, is a cash value component. This cash value accumulates over time, tax-deferred, kind of like a retirement account. It grows within the policy. And this cash value can actually be accessed by the policyholder during their lifetime through withdrawals or policy loans. Now, the presence of this savings component, along with the guaranteed lifetime coverage, is why permanent policies are significantly more expensive than term policies with similar death benefits. You're essentially paying for that lifelong guarantee and the built-in savings feature.
That cash value component is a big differentiator then. It offers a living benefit, not just a death benefit. Interesting. Are there different types of permanent policies? How do they vary?
Yes, absolutely. There are several types of permanent policies, and they each have a different approach to things like premiums, how the cash value grows, and flexibility. First up, we have whole life insurance. This is widely considered the simplest and probably the most common type of permanent life insurance. It's characterized by its guaranteed fixed premiums. They remain the same for the entire life of the policy, no surprises there, which is nice. The death benefit is also guaranteed. And crucially, the cash value grows at a fixed guaranteed rate of interest every single year. So for you, or maybe a family member who really prioritizes stability, predictability, guarantees over maybe high-risk, high-reward ventures, a whole life policy offers a really safe and straightforward way to build a reliable financial asset. This is particularly relevant if perhaps you have a distrust of more complex or volatile financial systems, maybe due to past experiences or just a desire for certainty. The guaranteed nature of whole life can be a source of immense comfort and reassurance. Okay, then there's universal life insurance. This is often called adjustable life insurance because it offers more flexibility than whole life. It allows the policyholder to, say, increase or decrease their death benefit, and even adjust or skip premium payments within certain limits, as long as the policy's cash value is sufficient to cover the ongoing costs of the insurance. This flexibility can be incredibly useful for people whose financial situation or family needs might change over time. Now, the cash value in a universal life policy typically grows with a guaranteed minimum interest rate, but the overall growth rate can fluctuate. It might be based on broader market conditions or the insurance company's investment performance. So while it offers flexibility, it does introduce a level of uncertainty that you don't get with whole life's guaranteed growth. And finally, we have variable and indexed universal life, IUL insurance. Now, these policies are generally riskier and more complex than whole or standard universal life. They offer the potential for higher returns, but also, yes, greater risk. In a variable life policy, the cash value is invested directly into sub-accounts. These are similar to mutual funds, baskets holding different company stocks to spread risk. The cash value's growth or loss is directly tied to how well those investment sub-accounts perform. Similarly, an indexed universal life, or IUL, policy ties its cash value growth to the performance of a specific stock market index, maybe like the S&P 500, which tracks 500 large U.S. companies. It usually comes with a guaranteed minimum interest rate, known as a floor, which protects against severe market downturns. But it also usually has a cap on potential gains during booming markets. So these policies offer the potential for significantly higher cash value accumulation, but they also expose you to greater market risk and typically come with higher fees. For individuals who are perhaps newer to the U.S. financial system, a really thorough understanding of these risks and complexities is absolutely essential before considering these options.
That's a lot to unpack, definitely. But it really highlights the spectrum of choices, doesn't it? From conservative to more growth-oriented. To give our listener a clear, concise summary, let's maybe do a quick at-a-glance comparison, like a cheat sheet for these different policy types. Okay, first, coverage length. With term, you're looking at a fixed period, right? Typically 10 to 30 years. Whole, universal, and variable index universal life, they all offer coverage for your entire lifetime as long as you keep paying the premiums, right? Now, moving to cash value, term has none, zero. Whole life has cash value that grows at a fixed, guaranteed rate, predictable. Universal life's cash value grows at an adjustable rate, but typically with some kind of minimum guarantee. And for variable index universal life, the cash value growth is tied to market or index performance, often with both a floor and a cap. More potential, more fluctuation. Okay, makes sense. What about premium stability? Term premiums are fixed for the term you choose, but they will likely jump up significantly if you renew the policy after the term ends. Whole life premiums are fixed and guaranteed for life. Very stable. Universal life premiums are flexible. You can adjust them, maybe even skip payments within limits, provided the policy's cash value can cover it. And for variable index universal life, premiums are also flexible, but importantly, you might need to increase them if the investment performance is poor, just to keep the policy going. Got it. And their primary use case. Term is for that cost-effective, temporary coverage. When you have significant but time-limited financial obligations, like a mortgage or young kids. Whole life is really designed for lifelong coverage and guaranteed asset building. It offers stability. Universal life provides flexible, lifelong coverage for those whose financial needs might change over time. And variable indexed universal life. That's for lifetime coverage too, but with the potential for greater wealth accumulation aimed at those comfortable with more investment risk. And finally, their risk profile. Term is low risk, no cash value involved, simple. Whole life is very low risk because of all those guaranteed values. Universal life is maybe moderate risk, as cash value growth isn't entirely fixed. It depends on interest rates or performance. And variable index universal life carries a higher risk because its cash value performance directly depends on the market. Okay, that really helps clarify the different offerings, putting them side by side like that. Now that we have a solid understanding of the types of policies, let's shift focus to something equally critical, maybe even more so, strategic timing. The decision to secure a life insurance policy at a young age. It's not just a tactical financial move, is it? It's really a strategic act of foresight with profound multi-generational benefits that I think truly echo the kind of long-term planning often seen in Ethiopian culture.
That's an excellent point. And honestly, it cannot be overstressed. Life insurance premiums are a direct reflection of your risk profile, and that's primarily determined by your age and your health. As we mentioned, insurance companies use those actuarial life tables to assess the likelihood of a person dying while their policy is in effect. Simply put, the younger and healthier you are, the longer your life expectancy is projected to be, and therefore the lower your premiums will be. And this relationship isn't linear either. The cost accelerates significantly as you age. For example, premiums can jump by 8% to 10% on average for every single year of age in your 40s, and it can be as much as 12% annually for those over 50. That's a significant increase that really adds up over the lifetime of a policy.
Wow, those percentage increases really hit home. They highlight the immediate financial advantage of starting early, but it's not just about lower premiums, is it? There's also that critical, often overlooked benefit of locking in future insurability.
Exactly. And here's where it gets really interesting and impactful for long-term planning. As we age, the possibility of developing chronic health conditions, things like high blood pressure, high cholesterol, diabetes, or even more serious illnesses, it significantly increases. It's just a fact of life. These conditions can either drastically raise the cost of future premiums, potentially making them unaffordable later on, or in some cases, they can make it extremely difficult or even impossible to get coverage at all. You might become uninsurable. But by securing a policy while you're still young and in good health, you essentially guarantee that your coverage will be enforced regardless of any health issues that might pop up later in life. Imagine a healthy young professional in their 20s or 30s getting a policy. If they later develop diabetes in their 50s, well, their policy is already in place. It protects their family without the huge burden of trying to get new, very expensive coverage, or worse, being denied altogether. It's truly safeguarding your ability to be insured, protecting your family's future against the unknown health-wise.
That's such a powerful point, especially when we think about the long-term well-being of a family and just the uncertainty of health. And you've spoken about how this idea of early action connects to those deep-rooted values within the Ethiopian diaspora. Can you expand on how it really resonates with those core principles?
Certainly. The Ethiopian diaspora is a community with an incredibly strong cultural emphasis on supporting family. And extended family, too. It's a value that often transcends borders. We see this commitment demonstrated through significant remittances sent back to Ethiopia, right? It's a practice reflecting a value system of responsibility that runs incredibly deep. So by purchasing a permanent life insurance policy at a young age, an individual can not only secure that substantial death benefit for immediate protection, but also begin building a tax-deferred cash value asset over time. And this asset isn't just waiting for a death benefit. It becomes a living asset, something you can use later in life, maybe to fund a child's education, serve as a supplement for retirement income, or provide cash for other family-oriented goals, perhaps even helping start a business here or funding a significant project back home. This really makes the policy a multi-generational tool for wealth preservation and transfer. It's like a modern manifestation of your community's deep-rooted principles of familial and communal support. It truly allows for a lasting legacy, ensuring that the fruits of your labor continue to benefit your family for decades, securing opportunities for future generations.
That's a fascinating and really deeply meaningful way to frame it. Making a financial tool resonate with such profound cultural values. Now, a common question that often comes up in financial planning circles is this: is it better to use a permanent life insurance policy as an investment vehicle, or should you just buy term and invest the difference in the stock market? I think this debate often oversimplifies things, doesn't it? Because these two strategies really serve fundamentally different purposes, and often a comprehensive financial plan benefits from having a bit of both.
You're absolutely right. It's rarely in either proposition. Often the most financially savvy individuals utilize both strategies for different objectives. Let's compare them, because they each have distinct pros and cons. Okay, the cash value component of a permanent life insurance policy, particularly a whole life policy, offers a level of stability, predictability, and guarantees that the stock market simply cannot match. The cash value grows at a guaranteed fixed interest rate, and its growth is tax-deferred, meaning you don't pay taxes on the growth each year as it happens. A significant advantage is the ability to access this cash via tax-free policy loans. You can borrow against this cash value, almost like taking a loan from yourself, and use the money for anything: a down payment, an emergency. These loans are typically tax-free. Just remember, though, any outstanding loan balance will reduce the death benefit paid out later, and interest does accrue, so it needs careful management. This makes it a powerful tool for diversification, especially maybe for high-income earners who've already maxed out other tax-advantaged retirement accounts like 401ks or IRAs.
Generally, you might see average returns around, say, 4% to 5% on the cash value component. Steady, predictable. Now, in contrast, direct investment in the stock market, maybe through an S&P 500 index fund, offers the potential for significantly higher long-term returns, often averaging around 7% to 10% for the S&P 500 over long periods. Historically, anyway. This is because stock values fluctuate based on market conditions, company performance, economic factors. But this higher potential for growth comes with a corresponding increase in risk and volatility. Stock portfolio can lose significant value during market downturns, as we all know. Also, any gains you make are subject to capital gains taxes when you sell either short-term or long-term rates. And for beneficiaries, an inheritance of stock investments might also be subject to capital gains taxes, and it can be a time-consuming, complex process to liquidate them. You might be forced to sell during a market dip.
So it really sounds like the most effective strategy often involves a combination of both, leveraging the unique strengths of each.
Precisely. That's usually the most balanced approach. Life insurance provides that guaranteed tax-free death benefit. It ensures financial protection for dependents, acting as a rock-solid safety net, no matter what the market does. Stock investments, on the other hand, are primarily focused on more aggressive wealth accumulation for future goals, like retirement or buying property. And by using life insurance to provide immediate liquidity for an estate, a person can ensure their loved ones are financially secure without being forced to sell other valuable assets like the family home or business interests, perhaps at an inopportune time or fire sale prices. This dual strategy approach really balances risk. It provides both a safety net and a vehicle for growth, creating a more robust and resilient financial plan overall.
Okay, now let's explore how the utility of life insurance extends far beyond just simple income replacement, which I think is often what people first think of. It can be a really sophisticated and adaptable tool for complex needs, particularly for those building wealth and establishing businesses, which, as we know, is a significant part of the Ethiopian American experience. For you, as part of a community actively building wealth and establishing businesses, understanding these advanced applications is pretty crucial for long-term success and stability.
Indeed, it really goes beyond the basics. For instance, a life insurance policy provides a stream of typically tax-free cash the beneficiaries can use to settle an array of final expenses and debts. This protects the family from having to bear these burdens directly during a period of grief. For example, the death benefit can cover funeral costs, which, as we said, can average over $7,000 in the U.S. easily. It can also be used to pay off outstanding debts, the mortgage, car loans, private student loans. This protects the family's other assets from being used to cover these liabilities. It means the assets you've worked so hard to accumulate, like your family home or your business, are protected for your heirs, rather than being liquidated just to cover debts.
And it has this powerful, almost diplomatic role in something called estate equalization, doesn't it? That sounds incredibly relevant for families with diverse assets, maybe not easily divisible ones.
Yes, that's a very important and often overlooked application, especially for entrepreneurial families. You're right. Estate equalization is particularly relevant when someone's estate includes illiquid assets, assets that are difficult to divide fairly among heirs. Things like a family business, the family home, or a piece of property. For example, think about a family that owns a successful Ethiopian restaurant, or maybe a retail store. If a parent wants to leave the business to the one child who's actively involved in running it, while other children have pursued totally different careers, well, a life insurance policy can be used to provide an equitable cash inheritance to those other non-involved children. This avoids family conflict. It prevents the forced sale of a beloved family business. It honors the wishes of the deceased and ensures fairness and harmony among the heirs. It's a way to make sure everyone feels respected and equally provided for, even when the assets themselves aren't uniform.
That's a fantastic solution for what could otherwise be a really contentious and potentially destructive family dilemma. Wow. And for those with substantial wealth, there are even more advanced applications to consider for tax planning, right?
Absolutely. For individuals with a high net worth, a life insurance policy can be strategically placed within something called an irrevocable trust. This helps minimize estate taxes. Now, an irrevocable trust, it's a more advanced legal strategy. You can sort of imagine it like a secure vault where you place your life insurance policy. Once it's in this vault, it's generally locked in. It can't be easily changed or retrieved by you, the original owner. But by doing this, the money from the policy, the death benefit, is no longer considered part of your personal estate for tax purposes when you pass away. This sophisticated strategy ensures that the death benefit provides a fast and tax-free source of cash for heirs. They can use it to pay any federal or state estate taxes that might be due. This is crucial because it prevents the family from being forced to sell valuable, often illiquid assets like real estate, art, or the family business just to cover tax obligations. It's a powerful tool to preserve generational wealth and prevent the forced liquidation of cherished assets.
That's incredibly powerful for those building significant assets and really planning for future generations. And speaking of building, the entrepreneurial spirit is so strong within the Ethiopian diaspora. So many individuals establishing and growing their own businesses. But the death of a business owner or even a key employee can create significant challenges, right? For the family's financial stability and the continuity of the business itself, life insurance sounds like an essential tool to mitigate these very real risks.
It absolutely is a vital tool for entrepreneurs. One key application is what's known as key person life insurance. This is a strategy where the business takes out a policy on an essential employee. This could be the founder of that popular Ethiopian coffee shop, maybe the lead salesperson bringing in most clients for an import-export business, or a critical engineer in a tech startup. The business itself is the beneficiary. The proceeds from this policy, if that key person passes away, provide the necessary capital. Capital to hire and train a replacement, cover operational costs during that difficult transition period, and maintain business continuity. This ensures the business can remain a going concern. It protects the financial interests of both the surviving family, who might rely on the business income, and the employees. It's a vital safeguard against losing the engine of the business, really.
So it's about protecting the very heart of the business from an unexpected loss. That makes sense. And life insurance also plays a crucial role in funding buy-sell agreements, correct? How does that work?
That's right. A buy-sell agreement. It's basically a legal contract. It outlines exactly how a departing or deceased business partner's share will be sold or reassigned, either among the remaining partners or back to the business itself. So what does this all mean for you, the entrepreneur? Well, by funding this agreement with a life insurance policy on each partner, the surviving partners, or the business itself, will have the immediate cash needed to purchase the deceased's share at a fair, pre-agreed price. This ensures a smooth, non-contentious transfer of ownership. It injects liquidity right when it's needed, and it guarantees the continued success of the enterprise, avoiding disputes and protecting the business's future without anyone having to scramble for funds at a difficult time.
That's such an elegant and proactive solution to what could otherwise be a very contentious, potentially destructive situation for a business, ensuring stability for both the business and the deceased partner's family.
It's exactly. By thoughtfully incorporating life insurance into a business plan, the entrepreneurial legacy that you've so carefully built, it's secured and protected for the future. It really fosters stability and growth across generations.
This has been incredibly insightful, really showing the depth and breadth of life insurance.
Wow.
Now let's talk about the journey to actually taking action. We know that navigating the U.S. financial system can be incredibly challenging, especially for immigrants. There's often a lack of familiarity with how things work here, potentially lower incomes to start with, and sometimes maybe a cultural mistrust of government or financial institutions, maybe due to past experiences in other countries. But, and this is important, with the right guidance and resources, these obstacles can absolutely be overcome. You've hit on such a crucial point there, one we see frequently. A significant barrier for many newcomers is just the sheer complexity of the U.S. financial system. It operates very differently than systems in their home countries. This lack of familiarity, sometimes coupled with a potential lack of trust stemming from previous negative experiences, can manifest as reluctance. A reluctance to engage in long-term financial planning, or maybe even just to ask questions about something as vital as life insurance. This really highlights the importance of finding a financial professional who not only has the necessary technical expertise, but who also demonstrates genuine cultural competence and empathy.
So it's not just about the qualifications on paper, but also about understanding and building that relationship based on trust.
Exactly. That's paramount. You're often looking for a financial advisor who truly understands your background, respects your values, and can serve as a trusted guide. Not just a transactional salesperson pushing a product. They should be able to gently guide you through new financial concepts. Maybe nudge-educate you, as the sources put it, explaining them patiently and respectfully, tailored to your understanding and goals, not using jargon or rushing the process. Building that trust is just so fundamental.
Yeah.
And it often comes from that feeling of being genuinely heard and understood.
That makes perfect sense. And fortunately, there are resources out there designed to help newcomers navigate this complex landscape, offering that vital bridge. Can you tell us about some of them?
Certainly. There are some great organizations doing important work, like Prosperity ME, for example. They do fantastic work empowering immigrant and refugee communities by providing financial education and counseling on essential topics like setting financial goals, building credit here, saving for the future. Similarly, the Office for Refugees and Immigrants, or ORI, in Massachusetts offers their Financial Literacy for Newcomers program, the FLN program. This program provides free, customized workshops led by financial experts. And crucially, they often have interpreters available, which helps bridge those critical gaps in language and culture, making complex concepts accessible. These community-based organizations can really serve as a vital first step, building confidence, building relationships with the U.S. financial system, and finding trustworthy guidance.
Those sound like invaluable resources for anyone looking to build their financial literacy and confidence. Okay, so for our listener who's feeling ready to take action right now, what are the methodical steps, the key considerations for securing a life insurance policy? Where do they actually begin?
Okay, taking that first step requires a thoughtful, methodical approach. But don't feel overwhelmed. Just break it down into manageable pieces. 1. Assess your needs. The very first step is to figure out how much coverage is actually necessary for your unique situation. This involves a pretty comprehensive evaluation. Look at all your outstanding debts, your mortgage, car loans, any private student loans. Consider your income replacement needs for dependents for how long. and account for future expenses, college tuition, maybe elder care, even potential remittances you want to ensure continue if you're not there. A good rule of thumb people often use is maybe 10, 12 times your annual income, plus all those outstanding debts and future needs added on. But it's very personal, too. Understand policy types. All right, next, take some time to reflect. Think about your financial goals, your personal comfort level with risk, and realistically, your budget. For someone prioritizing stability, predictability, guaranteed cash value growth, maybe whole life is appropriate. For someone seeking lower costs and coverage just for a specific, defined period, then a private term policy is probably a strong choice. Understanding the differences we discussed earlier term, whole, universal, variable, will empower you to make an informed decision. And a good advisor can help you weigh these options against your personal circumstances. 3. Find the right advisor. Okay, this step is crucial, cannot be overstated. Seek out a licensed and trustworthy financial professional, someone genuinely committed to helping you understand all the options available without pressure. Look for someone who is culturally competent, ideally someone with experience working with immigrant communities, maybe even the Ethiopian community specifically. A great way to find such a professional could be reaching out to local Ethiopian community centers, maybe faith-based organizations, or those immigrant resource centers we mentioned. Ask for recommendations. And ask them questions too. Do you have experience working with families from my community? How do you explain complex financial concepts simply? What are your fees? How are you compensated? This connection, this trust, can make a huge difference in getting tailored advice that respects your background and goals. 4. Review the fine print. Okay, last step, but vital. Before signing any document, it is absolutely crucial to carefully read and understand the policy's terms and conditions. All of them. This includes understanding the fees involved, all the fees, any potential surrender charges if you cancel a permanent policy early, and any provisions related to taking out loans or making withdrawals from the cash value. Don't be afraid to ask questions. Lots of questions. A knowledgeable and trustworthy advisor can and should patiently guide you through this process, clarifying any complex language so you are fully informed and confident in your decision. This protects your interests and ensures there are no surprises down the road.
This has been such a comprehensive deep dive, truly invaluable information. To kind of bring it all together, life insurance is really more than just a financial product, isn't it? It's a powerful tool for self-protection, for family security, and it's really a cornerstone of a well-rounded financial plan. For the vibrant Ethiopian community here in the United States, it offers this modern, efficient way to continue that beautiful tradition of mutual support and familial responsibility we talked about. And while the EDIR provides that crucial communal safety net for immediate final expenses, for emotional support, a formal, legally binding life insurance policy can create a much larger, enduring financial safety net. One that replaces lost income, repays debts, funds future ambitions, and helps build intergenerational wealth for decades to come.
Absolutely. And by taking action, you unlock so many tangible benefits. By starting early, as we emphasize, you can take advantage of significantly lower premiums. And you secure your future insurability, protecting yourself against potential health changes that could make coverage more expensive or even impossible later on. By choosing a permanent policy, you can build that predictable, tax-deferred asset. It serves as a foundation for intergenerational wealth, and it provides a living benefit you can actually access during your lifetime. And when it's combined thoughtfully with direct stock market investments, life insurance provides a really diversified and robust strategy. It truly balances the need for security with the potential for growth, creating a resilient financial future for your loved ones.
Ultimately, by taking these proactive steps to understand and implement a life insurance strategy, you are not just buying a policy, you are building a lasting legacy. A legacy that honors the past, strengthens the present, and ensures a prosperous and stable future for your families right here in your new home. It's about translating those deep-rooted cultural values into tangible, modern financial security. And really, what greater gift could you leave? If you found this deep dive helpful and maybe you want more insights like this, please do take a moment to like and subscribe to our channel. It really helps us bring more valuable content like this to you in the future.